Your next gas bill may be dramatically lower. What happens when oil giants unleash a torrent of supply? Let's uncover the high-stakes drama unfolding in the global oil market. Whispers from Vienna are turning into roar. OPEC plus the colossal alliance is on the brink of monumental July decision. They are weighing a jaw-dropping increase in oil output, a staggering 411,000 barrels per day, 3 times their original plan. This isn't a tweak, it's a seismic shift set to send shockwaves worldwide. Why this sudden aggressive surge, and what could it mean for your pump price, global energy, and our economy's very stability? The immediate fallout: a potential crash in crude oil prices. OPEC plus hikes already triggered oil's worst monthly performance in years. Their May adjustment alone dragged US benchmark prices to 59.2 USD a barrel. This tidal wave of supply, if it overwhelms demand, risks a brutal market glut. For some producers, financial devastation, but for you, the consumer, a golden ticket on cheaper gas. What's truly fueling this dramatic pivot by OPEC plus? It's a cutthroat game of market share and absolute price control. OPEC plus, formed in 2016, commands 40% of global oil production, with Saudi Arabia and Russia as its titans. But their iron grip is slipping. OPEC's market share has catered from 40% to under 25%, while the US share surged from 14% to 20%. This hike is a desperate preemptive strike to reclaim dominance from booming US shale. OPEC plus aims to drive prices below 55.6 USD per barrel. Saudi officials accept 60 USD per barrel even with increased borrowing. This reveals a brutal tension, balancing high national budget prices against a scorched earth strategy for dominance. While a supply surge could offer fleeting relief from inflation, it's a dangerous gamble that risks a market glut and could ignite a civil war within OPEC plus itself. The global crude oil market, a colossal $739.8 billion in 2023, projects only modest growth, a mere 1.6% to 2.1% CAGR over the next decade, constrained by the energy transition. Oversupply could swell oil storage by 720,000 BPD in 2025, sending prices into a free fall. Some OPEC plus members already reeling will buckle under quotas. Persistent non-compliance would accelerate the price collapse. And here's the chilling truth: lower prices are a catastrophe for oil-dependent economies. 2014 to 16 price plunge, a staggering 70% drop, sharply slowed oil exporting nations. So while your wallet might cheer, this move simultaneously destabilizes entire nations, creating a complex, unpredictable global ripple effect. This isn't just about barrels and bucks. A move like this sends seismic shockwaves through the energy transition, global power dynamics, and our very climate goals. Global crude oil supply is dominated by titans: the United States, Saudi Arabia, and Russia. Powerhouses like Saudi Aramco, ExxonMobil, and Chevron wield immense influence. This oil flood could derail clean energy investments. The accelerating energy transition is a long-term existential challenge for crude oil. As green tech spreads, crude demand slows, especially in developed nations. Yet, the transition is a patchwork. Energy access often trumps sustainability, keeping crude vital for petrochemicals in booming economies like China. Geopolitics is a powder keg. Trade disputes and regional instabilities like Red Sea inject volatility, dampening global growth and oil demand. The energy transition will fundamentally reshape international relations, shifting focus from fossil fuel disruptions to new vulnerabilities like critical minerals and clean energy supply chains. Here's the ultimate bottom line: if this increase happens, you could see a dramatic dip in gas prices. But buckle up. Extreme volatility will likely remain high. Lower crude oil prices mean instant relief at the pump, saving saving drivers money and slashing goods costs. This is a powerful stimulus for the US economy. A mere $1 a barrel oil price decline equates to $7 billion in annualized gasoline fuel savings for consumers. GasBuddy forecasts the cheapest Memorial Day gas since 2021, potentially falling below $3 per gallon this summer. Imagine the extra cash in your pocket for summer adventures. For industries, this brings desperate short-term relief via cheaper shipping. But for investors, it's a seismic shakeup. Lower oil prices signal deep economic uncertainty and can trigger reduced investment and job losses in the US oil sector. For policymakers, it's a nightmare scenario. Higher oil prices fuel inflation directly and indirectly. Energy costs are a significant part of what you pay for goods and services, and oil impacts everything from plastics to shipping. Historically, oil prices hit businesses harder than consumers, but those businesses' costs eventually trickle down to you. Experts warn that even small oil price hikes can push up overall inflation and slow down the economy. While global oil demand is still growing, the market might soon be flooded with more oil than we need, which would drive prices down. Analysts see different futures. Prices could stabilize, drop significantly if supply surges, or even rise if the global economy booms. So, is this a savvy supply move or a catastrophic gamble that could backfire spectacularly? Let us know your take in the comments. Like, share, and subscribe for the latest news. Stay tuned to Wantstats for the news that matters.